getting ready to hit an all-new record high on the S&P. This is Bloomberg Open Interest. We're just about 10 seconds away from the opening bell. You can see futures here up 0.2% on the S&P, up about 0.3 on the NASDAQ, and up 0.1 on the Russell as well. So we were almost there at an all-time record high. May have hit an intraday on Friday, but didn't close there. Of course, yesterday was a day off to celebrate the presidents of the United States of America, the previous ones. And we have the opening bell. Prudential is celebrating its 150-year anniversary. Have they been listed for 150 years? I don't know if they've been listed that long. Over the last 5 years, they have returned 52%, including reinvested dividends. Not bad for an insurance company. And then Iller is the ticker for a company called Triller. I had never heard of it, but apparently it's a TikTok rival. And I looked back to see President Trump used it when he first got kicked off of other social media platforms. And his last post was excoriating, ripping apart the protesters on January 6th. Now, I guess they're okay. But it's very interesting that they're ringing the bell there. The stock down 92% in 5 years, but it was a SPAC. So that's how those things happen sometimes. Katie, what do you see in terms of the major averages?
First of all, that was a great vocab word. I would not even know how to spell that. But you take a look at the major averages, we're kind of losing the steam that we saw building in the pre-market. We still have green on the screen. The S&P 500 up about 0.1%. That was closer to 0.4% just about half an hour ago. Same story, too, if you take a look at big tech in the NASDAQ 100, now higher by about 0.3%. Of course, the big tech benchmark is coming off of an almost 3% gain last week. We'll see what catalysts we have on dock in this holiday shortened week. And then the Russell 2000 also losing its bid a little bit, currently higher by about 0.1% on the small cap benchmark. Let's look under the hood here and talk about Intel, though. As we've been speaking about on this show, it's been on a tear recently. It posted its best week since 1982 last week, and it's now higher once again following reports that TSMC and Broadcom are looking into deals that would split apart this chip-making giant. You can see traders cheering that along. Intel shares currently higher by almost 5%, Shanali.
And Katie, I'm looking here at Constellation Brands. Shares are on the up and up after Berkshire Hathaway reported a new stake in the beer giant. The 13F shows that Berkshire holds a nearly $1 billion position in Constellation. Pretty fascinating, Matt, because earlier this year, this was a company that was feeling some jitters against tariff talk. But of course, the Oracle of Omaha here, some confidence in the stock.
Yeah, concerns, obviously, about tariffs for a number of U.S. companies. Constellation Brand, no different. In terms of other movers that we have and interesting stories on the day, Nike is teaming up with Kim Kardashian's underwear label Skims, working on an extensive line of apparel for women under the creative name Nike Skims. It will debut in the spring.
Yeah, so put your pre-orders in now. I'm interested to see.
Do they not have Skims for men?
No, I think they do. I think
it's like Spanx, right?
It's is, but they're branching out as evidenced by this partnership. It is interesting to see Nike shares higher on this because you have to imagine that Nike already has fitness lines for women. But I guess, you know, if you're trying to make Nike cool again, maybe you want to partner with
but those are all for people who are like fit, right? And this is for people who aren't fit to make you look fit. I thought the idea was to rein things in a little bit.
No, Skims is inclusive. Some of those dresses are really tight, so I think you want to be in shape.
I'm looking for a Skims IPO. That's what I'm looking out for.
Yeah,
all right.
We'll more about Skims than it is about Nike sometimes.
Okay.
That's true. Nike shares up about 3%, though. But let's bring in RBC Head of U.S. Equity Strategy, Lori Calvasina. She joins us now. And Lori, we have a Bank of America Fund Manager survey out this morning. The headline there is that investors haven't been this risk-on since 2010. But I wonder if you can say the same for CEOs, because you think about the tenor coming off these earnings calls, and it seems a little bit cautious.
No, I think that's exactly right. And as we have gone through this reporting season, we've been reading week to week. We tend to think about it in batches for different weeks. And at the beginning of this reporting season, there was a lot of optimism. And we really heard about that from banks and financial services companies in particular. But as reporting season wore on, we got more and more allusions to the idea of uncertainty. And a lot of that uncertainty coming out of the policy backdrop. And we've heard a lot about that general uncertainty in recent weeks, but also about tariffs in particular. And so it does feel like companies are maybe not quite saying as much as they could. We had really expected coming into this reporting season, companies would be talking about how post the election uncertainty being removed, that there would be this big unleashing of animal spirits. We're just not hearing that. We're also not getting a lot of color from companies about consumers and how they're acting right now either. So it's been kind of a quiet reporting season with undertones of uncertainty, to be sure.
Fortunately, I get up early enough to listen to Nathan Hager in the morning. You were on with him as well on Bloomberg Radio, Lori. And I thought it was fascinating, your response to the Bank of America survey. So there's so many things to pick apart in that survey, but my main takeaway is 89% of respondents think U.S. stocks are overvalued. And you have this like incredible level of high valuations meeting this level of high optimism. How does that work out?
So, surveys and, all these sentiment gauges, it really depends on who you're looking at, and they can differ from time to time. I'll tell you, in terms of just the overall optimism, what we see on AAII is that net bullishness is now starting to go back down to levels last seen in 2023, 2022, some really kind of challenging periods in the market. If you look at the Conference Board gauge on whether stock prices are going to go up, I believe that's sort of been sitting around all-time highs. I think that may have come in a little bit. If you look at the CFTC weekly data on U.S. equity futures positioning, it has been hitting all-time highs and is starting to ease. And I think that probably syncs up pretty well with that fund manager survey in terms of who it's looking at, more kind of the institutional side of the business. Now, on the issue of valuations, I will tell you, I was over in Europe and marketing some other places outside the U.S. back in December after we put our year-ahead outlook out, and I got an earful from international investors in particular about how overvalued the U.S. equity market looked. And sure enough, on my valuation modeling, I have a really hard time coming up with good math for the S&P this year. The best I can come up with is about 6,200. I'll spare you all those details.
Wow.
But if you look at plain old-fashioned forward PEs, whether you're looking at Russell, S&P X, kind of the Mag 7 cohort, equal weighted S&P, all those multiples are kind of hitting past ceilings and starting to retreat. So I think the market is also telling you there's just not going to be a lot of expansion this year.
What's also fascinating to me is if you break apart what's happening under the hood of the major indexes, you do have the NASDAQ outperforming the Mag 7 by and large, by a landslide, if you will. I mean, you have the NASDAQ up more than 5%, and you have the Mag 7 up 1.6% roughly on the year. If you look at the component parts of the NASDAQ 100, in the top 10, you only have one Mag 7 company. It's only Meta. But some of these other companies, Palantir, Constellation, they're not cheap by any metric either. How much do you have investors out there looking for a bargain or just following the herd? Because a lot of the companies that are performing well this year are still the companies that were performing well last year.
So I think the sort of tricky thing, right, is that if you look at, again, that top 10 cohort in the S&P 500 in terms of market caps, it's like Mag 7 plus a few extra. And you look at the rest of the market, you do a relative PE, and then you compare the relative long-term earnings growth of those two buckets. They tend to track each other, right? So we know that premium valuations are paid to companies that display premium long-term growth expectations. And there's nothing illogical or wrong with that. Now, I do think that as the market is broadening out, there's just not a whole lot that's cheap. Some of the sectors that investors wanted to pick apart in the year ahead discussions do look cheap, but it was things like energy, where there's, some concern about sort of supply dynamics and if you're really going to have support for the oil price going forward. So that one, I think that one's getting more generalist fans, but you can poke a lot of holes in that one. Healthcare, where there's tremendous policy uncertainty, has also looked quite cheap. So I have seen investors poke around, and take a hard look at some of those cheaper sectors. But I think you're hitting something on the head, Sonali, which is just the idea that it is very difficult to sort of find those true value opportunities. And some of those old winners, maybe not the Mag 7 in particular, but some of those old winners are still clinging on.
Well, do you look outside the U.S. for that? Because speaking of year-to-date stats and surprising facts here, the Stock 600 is up about 9% year-to-date on a total return basis. You compare that to the S&P 500, only up about 4%. People clearly looking to Europe right now. Lori, would you chase that rally?
So look, I only cover the U.S. And I don't make calls in sort of U.S., non-U.S. But what I have told people, and again, this kind of goes back to my December trip to Europe. I didn't find a single person in a week, in like 5 or 6 different cities who wanted to buy Europe over the U.S. It felt to me like the most out of favor moment I've ever seen in my career for Europe, and that usually is telling you something. If you look at the funds flow data on EPFR that comes out every week, it has been showing moderating inflows to U.S. equity funds, and that's coming as passive is turning or trending lower again. Rather, active is turning negative. Passive is kind of losing its momentum, and we are starting to see Western European equity funds reapproach positive territory. They're not really back in it firmly yet, but they're kind of flirting with it, and you've seen a clear improving trend. You've also seen the same thing for EPFR's data on Germany equity funds. So I do see some, signs of that geographical rotation, and what we do know is that over time, when growth is beating value within the U.S. tends to outperform Europe, and vice versa. When you see the market kind of broaden and the value trade come back, we do tend to see non-U.S. geographies do well as well.
Lori, great to have you on with us on Bloomberg Television after your appearance on Bloomberg Radio this morning. RBC's Lori Calvasina, thanks very much for the double duty. Coming up, pharma execs meet with the White House to discuss potential reforms and RFK Jr.'s priorities as health secretary, but pharmacy benefit managers won't be at that meeting. We'll talk to one of them, CVS Health's executive VP Prem Shah, about where he sees U.S. healthcare under Trump's second term. This is Bloomberg.
All right, welcome back to Open Interest. Let's take a look at some breaking news we have here on the geopolitical front, and that is that Zelensky cancels his plan to visit Saudi Arabia on Wednesday. This headline just crossing, of course, just hours after the U.S. and Russia concluded their negotiations in Saudi Arabia's capital. And now the news coming that Zelensky has canceled his plan to visit Saudi Arabia on Wednesday, not having too much of an impact in the market right now. You can see the S&P 500 still higher by about 0.1%, gains of similar magnitude if you look down the board here.
It does look like he will go in March.
He will go in March, but not on Wednesday. So
right.
we'll continue.
Wednesday's not March quite yet.
That's true. Wednesday is
still.
So the week after.
The week after.
Possibly.
Well, March is a month long, so.
Yeah.
But as we know, other critical conversations are going on right now.
There we go. Let's have a critical conversation right now, because this week, CEOs of big pharma companies, including Pfizer, Merck, and Gilead, will meet with President Trump to discuss potential reforms in the sector. Now, who's not at the table this week? It's PBMs, pharmacy benefit managers. Those are the middlemen that are responsible for negotiating drug prices. Let's get some more insight now from a major PBM player, CVS Health. Prem Shah, he is the executive vice president and group president of CVS Health, and I'm pleased to say he joins us now. Prem, it's great to have you with us, and just set the scene for us briefly here, because I think this is an issue that confuses a lot of people. What role do PBMs play when it comes to drug prices? Where do you actually sit in the process?
Yeah, Katie, first off, thanks for having me on the show. PBMs, or pharmacy benefit managers, have been inside of the U.S. healthcare kind of industry over the course of the last 30 years. And they are a very effective tool to, one, serve the customers and clients that we serve. So if you think about pharmacy benefit managers, they serve 275 million Americans, and they deliver the benefits for them across the country. And their primary role is to administer those benefits and lower the cost of drugs inside of the supply chain. If you think about where drug costs come in the United States, if you look at the healthcare dollar, about 90% of the prescriptions in this country drive only 10% of the cost, and 10% of the prescriptions drive 90% of the cost. And so PBMs drive competition. They create services and solutions that help make prescription drugs more affordable in this country. And, you know, they generate a lot of savings, right? We've proven our savings for the healthcare ecosystem,
right.
You know, and over the course of the last decade, or over the course of the next decade, they will drive over $1 trillion of savings in pharmacy supply chain. So we're excited to continue to play our role. It's an essential element in the way we deliver benefits and drive down the costs in the U.S. healthcare system.
Well, talk to us about your relationship then with the Trump administration, because obviously we have CEOs from the big pharma companies meeting at the White House this afternoon, I believe. And you think about Trump's own words saying in December that he's going to, quote, knock out the PBM industry. What have your conversations sounded like with this administration?
Look, we're really excited about our conversations with the administration, and we're engaging with policymakers at the local, at the state, and at the federal level. And if you think about those discussions, they've been around, you know, what's really going around in all of our own homes, which is around how do we make drugs more affordable for U.S. consumers and patients that we serve. And so we continue to have an active dialogue with the government at many levels. And, you know, we're excited to continue to work with the Trump administration to help reduce the cost of drugs and make them more affordable for every patient that we serve.
But he says he wants to knock out pharmacy benefit. I'm not really making this connection here. You're excited to work with a president who wants to eliminate your entire industry. I get that you want to be optimistic when you're public facing, but it doesn't sound like a good match to me, the pharmacy benefit managers and the Trump administration. How will you convince him that you really are lowering prices?
Yeah, look, I think there's a few things, Matt, to answer your question. First and foremost, the pharmacy benefit management industry has been under pressure over the course many times prior. And so if you think about what we do, first off, we create affordability for consumers at the counter. The average patient today for prescriptions pays less than $8 when they use Caremark. Secondly, one of the things that always comes across is, you know, the PBMs aren't transparent. We've created models. Last year, we launched something called True Cost inside of our pharmacy benefit manager, where we're being 100% transparent with our customers and the members that we serve in terms of driving that transparency. And third, if you think about who uses pharmacy benefit managers, our customers are government constituents. They are Fortune 500 employers. They are, in fact, some of the same pharma manufacturers that put pressure on us, they use PBMs as well to administer their benefits. And so we're excited to show the value proposition that we deliver to the U.S. healthcare system. We lower the cost of drugs. It's proven. And we're excited to show that to the Trump administration as well. And sometimes, let's just be honest, the stakeholders that are driving the prices of drug, which is big pharma right now, they're trying to shift the blame over to PBMs. That's not true.
Right.
If you look at just
Prem, let me just jump in and ask. I spent a number of years living in Germany, and I lived in the UK for a number of years. And I paid far less for my drug needs in both of those countries than I did in this country. Would CVS be for, a one-payer system, or governments negotiating with the pharmacy companies directly? Because it's worked out so much better in other countries than it does here.
Yeah, I don't think that's the answer, Matt. I think the issue that you see is there's cross-subsidization, and the U.S. is paying more than their fair share for branded pharmaceuticals inside of this country. And if you look at the prices in the U.S. for branded pharmaceuticals, they're 4 times higher than other countries across the world. And so part of the issue is, how do we pay the right amount for medications and also afford the innovation that some of these products bring to bear? And so, in that example, we're just subsidizing some of the other countries and the prices that they pay. And, what I think we have to do is figure out how we can continue to create competition and drive that forward. If you think about some of the things inside of our supply chain, generic drugs is a good example. One, the U.S. has the highest generic dispensing rate of generic prescriptions. Those are the lower cost prescriptions, and they are very affordable inside of the
I want to jump here as well.
System.
Shonali here. Good to speak with you today. You made a point a little earlier about how the pharmacy benefit manager system has faced criticism, not just in the current administration, but in prior ones. And there was a suit brought forward by the FTC last year, particularly when it came to insulin prices. They were very clear that they would be looking at other drugs as well. When you think about the tone taken from the agencies, particularly with all the change going on in the current administration, do you think this suit and others that are under the surface may not exist in the same fashion? Do you have any indication that these particular actions would go away, or do they stay just as stringent given what the president has said?
Look, I think there's a couple things. First off, I think that suit cherry-picked a single set of drugs. When you look at the overall value proposition that PBMs bring to the marketplace, our customers get to choose every year who their pharmacy benefit manager is. It's an extremely competitive process. And so, I'm excited to continue to show that data and show, what we bring to the market. And I think we'll work with the administration to show them exactly that, show them, the value proposition that pharmacy benefits managers bring, how we're reducing costs and driving that competition forward for the industry. And, again, in that one suit, you're really cherry picking a few single set of drugs. It's not an accurate reflection of the savings that we provide to all our customers day in and day out.
And Prem, before we let you go, point taken that you're looking forward to working with this administration, but you think about on the lawmaker side, you have some lawmakers wanting to break up companies such as CVS that run pharmacies, PBMs, and insurers as well. Do you see that as a possibility? What would a broken up CVS look like from your perspective?
Look, I ultimately, the 300,000 colleagues that we have serves our country, and they wake up every single day to try to improve the quality of care in this country and to reduce the cost of care in this country. And if you think about our 3 sets of assets that we have, our provider assets in terms of our CVS Pharmacy and our healthcare delivery assets, our pharmacy benefit manager assets in terms of how we help drive and reduce costs on pharmaceuticals, and our insurance assets, I'm excited to think about how we integrate those assets, how we help to continue to improve the quality of care, and how we can really drive affordability inside of the U.S. healthcare system. So I don't think that, from my perspective, I think that the integrated value proposition we have is extremely powerful and is going to drive material change that drives and improves the quality of care in this country. And we're excited about what we can bring to bear over the course of the next, upcoming years.
Well, Prem, we really appreciate you taking the time to speak to us today. I hope to do it again soon. That is CVS Health Executive Vice President and Group President Prem Shah. This is Bloomberg. Welcome back to Open Interest. Quick check on stocks right now. You can see the S&P 500 still up about 0.1%, but there's a lot of drama under the hood. Let's take a look at Walgreens. It was briefly halted for its limit up, surging as much as 9% at one point. Trading has since resumed. You can see it's building on those gains, about 10% right now. No clear catalyst for why, no clear news coming across, but we'll continue to monitor this one.
And it's a stock that's been cut in half in the last 12 months, down 50%. Coming up in the next hour, Kristen Peck joins us, the CEO of Zoeta, as well as Matteo Marietti, the co-founder and CEO of Cook Unity. All right, we're 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld.
And coming up, Bank of America says investors haven't been this risk on in 15 years. Meanwhile, Larry Adam of Raymond James warns that too much optimism may be the biggest risk to markets.
Is Cook Unity serving up an IPO? The CEO of the meal delivery service tells us what's in store as competition heats up.
And Zoetis gets a conditional license from the USDA for its bird flu vaccine. We'll discuss the latest developments with CEO Kristen Peck. All of that and more coming up. Let's take a look at these markets, though, before we get there. Small moves overall. The S&P 500 pretty much unchanged. As to, is the NASDAQ 100 really giving back those pre-market gains on pretty hefty volume, I I will point out, trading on the S&P 500 about 25% above its 20-day average. Then you take a look at the bond market. We're still above 4.5%. Bond yields higher on the 10-year yield by about 3 basis points, Matt.
All right, pretty interesting moves there. The S&P still trading at 61.15, so that's near the record high of 61.18 on the 23rd of
fragile
January.
heights.
Fragile heights, I guess. Let's talk about this with Larry Adam right now. Raymond James, Chief Investment Officer. Larry, there's so many different signals here. We see the Bank of America survey that shows investors are more willing to take risks than they have been in the last 15 years, judging by their cash levels at the lowest since 2010. On the other hand, Simon White from Bloomberg is out with a great piece today showing hedge funds are shorting the smart money while retail investors are incredibly optimistic, what some would pejoratively call the dumb money. What's your view?
I think there's a lot of optimism out there, particularly on the retail side. I mean, when you look at some of the things that we look at, for the fact that if you look at like the University of Michigan survey or consumer confidence, you have a record amount of people that actually think the equity market is going to go higher over the next 12 months. And historically, that's been a contrarian indicator to at least suggest that you have flattish to slightly down type of markets. When you look at positioning and the fact that retail investors have some of the highest allocations that we've ever seen to equities, when you look at fund flows, when you look at the put-to-call ratio where there's not a lot of hedging taking place on behalf of retail investors, and then when you look at the VIX, you know, that's still at relatively low levels. So I think there's still a lot of uber optimism on behalf of retail investors. And now, as you suggested, you're starting to see it on behalf of institutional investors. So when you have that type of optimism, I think you need to be at least a little bit more cautious here in the near term.
It's incredible. Just 6-7 weeks into the year, really, we're looking at a very different conversation, guys, than we have been. A lot of investors seeing the S&P meaningfully higher. But Larry, you're talking about flattish to lower. A little earlier, Lori Calvasina saying 6,200 on the S&P might be hard to come by. If we are thinking that flattish to lower is the path forward, what gets you there? If you think about an S&P that could actually end the year lower, not higher, what would bring it there?
Well, our official target is 63.75, which again isn't that optimistic compared to a lot of the other forecasts that you see there on the street. But what I think has to happen is you cannot get PE expansion. I think we're at the upper end of where PEs can go. You have to get earnings growth. And our expectations are that you're going to get roughly 10 to 13% type of earnings growth, and that's what's going to have to be the driver of the equity markets moving higher. We also think you're going to see a broadening, and when I say broadening, I do include technology still in that. I just think you're going to see more participation in other sectors like industrials, in healthcare, to really help lift the market, again, just modestly over this upcoming year.
And Larry, I'm going to do something I never do, and that's bring up Europe. We've been talking about it all show, the fact that you have Europe actually outperforming the Stoxx 600, outperforming the S&P 500, and, of course, our Magnificent Seven names so far this year. Real vibe shift relative to really the last decade. What do you make on that? Can you extrapolate out that people are just worried about U.S. valuations right now?
No, look, I think this is a short-term trade. If you look at RSIs right now, I think that Europe is overbought. So I would look for at least a pause in European performance. More macro speaking, I still like the U.S. over Europe and other international markets for a couple of reasons. Number one, I think you have much better economic growth here in the United States, far outpacing what you're going to get in particularly Europe. That leads to better earnings growth. As I mentioned, we're talking about double-digit earnings growth here. You're going to have mid-single digits over in Europe. And then I think you can't overlook the fact that when you look at technology, you really don't get any technology exposure over in Europe, and you get a lot more here in the United States. And I think that's going to continue to be a critical driver going forward. And then my final point is that we do think you're going to see some tariffs, particularly on Europe. And if we do actually start to see them implemented, I think that's going to hurt that market more so than the U.S. equity market.
I wonder what you think about gold, Larry. I've been pretty fascinated by the precious metal over the past week because of a couple of stories. Right now, it seems like we're seeing a flood of physical gold come into New York from London. But Sonali brought up a story about Goldman Sachs this morning. They're raising their target potentially to 3,300 a troy ounce. Not that it's, you know, something you want to be too long, obviously, but how important is gold as a part of an investor's portfolio?
You know, you can have a piece of it as for diversification in case there is any type of geopolitical risk. But I think right now, you're starting to lean to the other direction, right? We're starting to get some calm, if you will, over in Israel. You could potentially see some type of ceasefire with Ukraine and Russia. If you look at what's going on with tariffs, if we have much more of a pragmatic approach where you don't see the negative consequences, I think you could see, less money going into gold. And I would say that over the last 2 years, gold's gone up when inflation has been lower. It's gone up when inflation's gone higher. So I'm not necessarily sure that's the inflation hedge that everybody thinks that it is. It's been more of a sentiment indicator, and with fund flows driving it higher. And if you see any type of fund flow starting to come out of that space, I think you could actually see gold prices move lower over the next year.
Fascinating. If you think about all the risks out there, you mentioned those geopolitical risks, but also that tariff risk, as we've been talking about. Your team has some really interesting estimates on how that might exactly start to impact markets. For example, every 1% increase in the effective tariff rate, your team has written there could be a 0.1% drag on growth. And this is a market that has been addicted to growth. And so if you think about the potential tariff rollover effect, what are you expecting to actually take effect? And how do you prepare investors for that?
So we think the average weighted effective tariff rate, which is at the beginning of this year, is 2.5%. We ultimately think it goes up to about 7.5%. And the significance of that is that I think you are going to see tariffs on China. You're going to see them on Europe. You're going to see them on some of the emerging market economies like India, Vietnam, maybe Brazil. But I don't think you're going to see them on Mexico and Canada. So that's our base case. When you look at how we are positioning, first of all, we thought that this would lead to volatility. So our key message to clients was don't really take the bait and try and take these knee-jerk reactions, because you will get whipsawed. As quickly as they can put out a tariff headline, it can be taken back. When it comes to our positioning globally, as we've mentioned, we favor the U.S. over international, particularly Europe and some of the emerging markets, because we think they'll be more negatively impacted by tariffs. From a sector position, we prefer those sectors that have much more of a service orientation and have pricing power, as opposed to having much more of a focus on the consumer, which leads us to favor areas like technology and healthcare, which definitely have pricing power and visibility in their earnings. And then when you look at our overall portfolios, given the expectations that we thought we'd see more volatility, we've kind of brought back some of the horns of volatility. We're focusing more on large cap and mid cap stocks, and less so on the more volatile areas of the markets like small caps.
Certainly a lot of investors recalibrating here. Larry Adam of Raymond James, we thank you so very much for joining us to start off the week here in the United States. We also want to take a look at what's moving under the hood here. We want to look at the S&P 500 because, of course, we have been fluctuating all morning, and one of the biggest drivers now is Walgreens. You have a report out from CNBC saying that talks may continue here with Sycamore Partners. Remember, this is an active deal stock, let's call it, up 14% now on the day. Bloomberg News is reaching out to representatives from Walgreens and Sycamore for comment.
Right.
It's been a brutal run for Walgreens otherwise.
Yeah, that is your biggest mover in the S&P 500 right now. Not too much on a points basis, though. And you talk about this brutal run for Walgreens. I mean, this company has seen 3 straight years of double-digit losses. Last year, 2024, down about 64%. It reminds me a little bit of Intel, that traders just want to see some sort of deal here.
I mean, here you see the 5-year chart. It's down 80%. Hard to lose much more value than that. And that includes today's 14% gain.
Can't even see it on the 5-year chart there. So we'll continue to follow that story. But coming up, the U.S. may be moving one step closer to curbing the avian flu outbreak. We'll speak to the CEO of Zoetis next about their vaccine's conditional approval. This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. Ukraine's President Volodymyr Zelensky is canceling his plans to visit Saudi Arabia tomorrow. Zelensky spoke after meeting his Turkish counterpart Recep Tayyip Erdogan. His visit to Turkey comes as top U.S. and Russian officials held talks in Saudi Arabia to discuss ending the war in Ukraine, but they ended those talks and haven't said when they will meet again. Zelensky warns his country will not recognize any agreements that are made, quote, about us, but without us. And Hamas said it will release 6 Israeli hostages on Saturday, as stipulated in the first stage of the group's ceasefire agreement with Israel. In return, they expect Israel to release a proportionate number of Palestinians. According to their Telegram channel, Israel will start negotiations on the second phase of the ceasefire with Hamas as early as this week. Finally, Bloomberg has learned that Elon Musk's government efficiency team is trying to access a broad range of taxpayer data. Democratic lawmakers raise concerns over privacy issues. The U.S. has strict laws that prohibit the disclosure of taxpayer data, with some exceptions for law enforcement. Of course, President Trump himself hasn't released his tax returns.
Well, that's a whole other story. But let's switch gears here and talk about bird flu, because Zoetis has been granted a conditional license from the USDA for its avian flu vaccine. Since February 2022, more than 150 million birds have been affected in the U.S., causing egg prices to surge to all-time highs. Joining us now is the CEO of Zoetis, Kristin Peck. Kristin, it's great to see you in studio, first of all.
Oh, it's very nice to be back in studio with you all.
So let's talk about your vaccine. When might we expect to see it roll out, and how quickly would you expect that to actually show up in the price of eggs?
Sure. I mean, what I want to start with is just really that my heart goes out to all of these, producers, both for broilers and egg layers. They've been on the front lines of this crisis for a while now, and they've been doing everything they can through biosecurity and many other strategies to try to control this. And Zoetis has been standing by and supporting them as we think about biosecurity as well as diagnostics, on farm with them, aligned with our purpose. So we were thrilled to get the conditional license of our AI product for poultry specifically. And just to be clear, this is a conditional license that is up to regulatory authorities in partnership with producers to decide how and when to use. So the sole decision on the use of the vaccine is up to the U.S. authorities.
Interesting. And I'm curious, what this means for your business, because as we've spoken about before, you're more heavily weighted to pets, towards animals that we have in our houses versus livestock. So with that in mind, depending on the uptake, what could this mean for Zoetis?
For starters, what I think this is a great example is what you and I spoke about at JP Morgan just a few weeks ago, which is the strength of our innovation pipeline across species, where we're expecting, a major approval every year for the next few years, many of which will really be blockbusters in important categories in animal health, such as chronic kidney disease, oncology, cardiology, and antibiotic alternatives for livestock, et cetera. So we're really excited about that pipeline. We think this is a great demonstration of that.
I don't want to get too far away from the avian flu. We spoke with the NEC director, Kevin Hassett, about what's happened recently. Listen to what he had to say.
What are we going to do about the fact that Joe Biden last year killed 130 million chickens, and that's why egg prices are so high? We're putting together a plan to manage the avian flu in a much wiser way.
So he says they were putting together a plan to manage the avian flu in a much wiser way. Obviously, a vaccine would be great for those animals who haven't gotten it yet, but you also make Draxxin, right, which is a drug that I'm not a doctor or a vet, but somehow helps cows and swines with respiratory illnesses. Are there other ways to deal with this problem, or do you really have to nip it in the bud?
Sure, there's many ways to deal with this problem. And I think, what Zoetis is focused on is supporting our customers with a whole set of tools in order to do this. What I was talking about before is really partnering with our producers to first start around biosecurity, which they're focusing, very intently on. But it is a challenge when a lot of the new spread you're seeing is spread by wild birds. And so you can't really stop the wild birds from flying over your farm. And that is really what is spreading some of the new. We can also focus on better diagnostics to better understand that. There's lots of different tools in the toolbox. Obviously the vaccine is one additional one, and it's aligned with our purpose at Zoetis to nurture the world and humankind by advancing care for animals. And that's a One Health focus, which is, I think, what the White House and the Congress and the USDA has been really focused on.
And not to put the cart before the horse, so to speak, but, when you think about the expansion of the vaccine, I recognize that you still need regulatory approval, but what about other animals? Do you see yourself making one for cattle?
You know, we've really stepped in multiple crises over the years. So we were helping the USDA with a vaccine that they used in their stockpile ban in 2016. As you think about the COVID crisis, we made vaccines that were used throughout wildlife and in zoos and things like that. So we will continue to partner with the USDA to meet whatever their needs are.
I want to broaden out a little bit because you mentioned your pipeline that you have coming up. There's a lot of excitement over renal disease, for example. You think about cats, kidney diseases are really fatal to cats. And like you said, I mean, you have big blockbusters expected for the next couple of years. But then you take a look at the stock price. Over a 5-year basis, you're up about 13% on a total return basis. That compares to about 52% for your peer group. So with that in mind, what do you think that shareholders are missing here about the story?
Yeah, we were thrilled to deliver double-digit top and bottom line performance for 2024 and to give an operational guide for this year at the top line at 6 to 8% for organic operating growth. I think there was a little bit of a disconnect with regards to foreign exchange for us, which was $250 million on the top line for us in 2025, $50 million on the bottom line, as well as a divestiture for us of medicated feed additives, which is around $355 million that need to be taken out. So we're working through some of that, which we don't really believe was embedded in the consensus, as we saw last week. But we're really confident that we've got multiple drivers of sustainable growth in what is just a phenomenal industry in animal health, which has been incredibly resilient and durable.
What does the product mix look like? If I look over, just a list of your medicines, I see obviously dealing with parasites is first and foremost. Then you've got like itchy skin problems, right? And then joint issues like arthritis. Are those the three biggest categories?
Yeah, we've got multi-billion-dollar franchises, and the biggest categories where we've been driving double-digit growth. Again, in categories such as paras and dermatology, they've been around for more than a decade. So all of these are billion-dollar franchises for us, the largest being parasiticides. You've got dermatology, where we've been in that market for over 11 years, still last year driving 17% growth. And then in OA pain, where we're really excited about the recent launch in the U.S. of Librela, of Silencia, which has been on the market in international for many years, and adding to that over the coming years in renal, oncology, cardiology, et cetera.
By the way, do you produce all this stuff here? Do you have overseas labs? I mean, the strong dollar, is that really an issue for you?
So the good news is we have a global network, global supply chain. Our largest manufacturing sites are actually in the United States. We also have some significant sites in Europe, but the U.S. is our primary manufacturing place for our business.
So the dollar hurts.
Right.
Well, the dollar does hurt, yes.
Well, to that effect, you're a CEO of a company. You want to focus on your products. You want to focus on your competition. You want to focus on getting new things out there. How much do you have to think about the strong dollar dynamic, particularly with all the tariff threats out there, the ride higher in the dollar?
Look, our focus is living our purpose and meeting our customer needs every day. We certainly are not experts in foreign exchange. So our goal is to deliver for our customers the products and solutions that they need. Obviously, we've got teams who manage scenarios as you think about, for tariffs, obviously. But we don't really manage day-to-day foreign exchange. We focus on living our purpose.
All right, Kristen, that's a good place to leave it. Great to speak to you today in studio. That is Zoetis CEO Kristin Peck joining on the news that Zoetis has been granted a conditional license for its avian flu vaccine from the USDA. Now, still ahead, Nike betting big on Kim Kardashian. We'll tell you about the details of a new partnership made in shapewear next. This is Bloomberg. All right, it's time now for Social Climbers. The company is making waves this morning. And first up, Southwest cutting over 1,700 jobs in its leadership ranks in efforts to cut expenses. It's the first time that the carrier has had to implement layoffs. Southwest also rethinking its famous one-size-fits-all business model. Next up, Coca-Cola is launching a prebiotic soda called Simply Pop. It's taking on upstarts including Olipop and Poppy. U.S. soda consumption apparently has fallen over the last 2 decades, hurt by health concerns and competition from alternatives such as energy drinks and cold brew coffee. And finally, we've been talking about it all show, and that's the fact that Nike and Kim Kardashian's underwear label Skims are teaming up on a new fitness brand geared towards women. The first Nike Skims collection will debut in the spring, and Nike really putting a renewed focus on women athletes as it begins its turnaround effort under its new CEO. And the partnership, good news, Matt Miller, it may even expand into menswear, so soon you too can get some Nike Skims, it sounds
I'm just
like.
not 100% sure on what it is, because we called it shapewear also. So is it just underwear or is it a girdle?
It's not underwear, it's shapewear. So you put it on and, you know, it sort of holds everything together. It's not, you probably wear underwear underneath it, but maybe these are things you should Google.
Yes.
Or
yes.
talk to a woman, I don't know.
I'll use,
I'm going to be
I think men
sending
can wear girdles as well.
Skims clothing on Instagram for the next month, so you finally get it, and I'm going to enjoy it so much.
You're going to send me pictures of people in their underwear?
It's not
I think
only
that would be
underwear.
against policy.
It's
I don't believe HR would be okay
not
with
only
that.
Underwear. It's like leggings. It's all sorts of shapewear.
Can you give us a check on the markets?
I would love to. Don't do any of that on your work phones. Let's take a look at these markets right now. The S&P 500, we're actually unchanged still, but the color is red, so some movement there. Now it's green. You have more direction when it comes to the NASDAQ 100. Your big tech stocks down about 0.1% right now, even with that pop that we're seeing in Intel. And then you take a look at the 10-year yield, that sell-off holding in the bond market right now. 10-year yields still higher by about 3 basis points, Matt Miller.
All right, we're going to talk to Cook Unity when we come back. Turning profitable as they turn up the heat on the meal delivery marketplace. We'll speak to the CEO, Matteo Marietti. This is Bloomberg.
This is Bloomberg Open Interest. Let's get a look at stocks moving this hour with Bloomberg's Denitsa Sekova, starting with Walgreens, because of course the stocks under the surface today are what's moving the index.
Yes, we saw trading halted earlier today. Of course, the news this time is coming from CNBC, and it's about the company being traded, taken private. Earlier, just a few weeks ago, we heard that it's not happening. Now we hear that indeed it's happening, and we saw a surge of as much as 14%. Of course, Walgreens has been struggling amid declining pharmacy reimbursements, competition from online retailers, and the talks about taking the company private has really revitalized the stock, where we saw so many cost-cutting measures that really a sign of the times is that they removed their dividend after 92 years. So, of course, those talks are very shaky, but that could potentially bring more optimism for the stock.
Yeah, we actually reported a few days ago as well that they hired Perella Weinberg Partners here and Alex Partners alongside another company to get help. So we knew that deal activity was probably coming.
Taking out your dividend after 92 years is rough, right? I can
that
imagine the conversation with my broker. Like, no, they won't cancel their dividend. They've been paying dividend for 92 years.
Yeah, that is a tough pill to swallow, I'm sure, for a lot of investors. And I mean, Walgreens, it's basically a penny stock at this point, so it'll be interesting to see if we get some movement there. Speaking of deals and potential deals news, let's talk about Intel also popping in a big way today on some speculations.
Yeah, a great day for Intel after another amazing week. Last week was the best week in 25 years. We're seeing two different deals, one coming from TSMC, one coming from Broadcom. Bloomberg, of course, reported about the Broadcom one. One is looking into more like the chip making business. Other is looking more into the marketing and chip design. So this big company will obviously be broken in two. We know the company has been struggling for some time. So of course, it was a very important big leader, but
An American icon.
An American icon, indeed.
Yeah,
and
trying
it
really
still
hard
is.
to push that.
It still is, but of course, artificial intelligence is changing the name of the game, and Intel has been caught up into that. But now we're seeing a lot of optimism. Analysts, though, are warning against the same thing with the deal. A lot of the talks are preliminary. There is nothing put on paper, and in fact, Intel hasn't heard too much about it. So it's too early to be too excited about it.
But it stocks up. In 5 days? Is this 5 days? 32%.
That was 5 days.
Wow.
Well, we were talking about
incredible.
last week, the best week since 1982. That's crazy.
Yeah, especially for a stock like Intel. That was its heyday.
Broadening set of partners. I think that's what's exciting about it.
DraftKings.
Oh,
I want to bring up
love this story.
the D King. Price target raised at Truist. Price target was raised at Piper Sandler. Price target was raised at Stifel this morning. Price target was raised at Citi. And yet, the stock is down 4%. What's going on?
Yes, I mean, we're coming off a strong rally from the earnings. Just remember, after the earnings, they had a 15% jump. So it's coming off of a strong start. We actually saw a few more upgrades. We saw Oppenheimer, we saw Northland, and everyone is saying outperform, $60, $68. So there is a lot of optimism in the air. Earlier in pre-trading, there was more optimism on the stock, so potentially we can go from there. When it goes to the CEO, he's saying that obviously legalizing more sports betting is a long-term boost to the company. We know that this season wasn't the best one for DraftKings, so potentially this is where some of the negativism comes. But going forward, all those upgrades should mean something, and there is a lot of optimism about the stock.
Remember, not a profitable company, set off another borrowing wave today. Largely, investors have liked it, even if it's not for today.
Oh, you're talking about the company borrowing,
Yes,
not
exactly.
destitute gamblers
Oh my
borrowing to fuel their
Correct.
addiction.
That might be happening as
We
well.
don't recommend that.
It's always good to deal in addictive issues. All right, Denitsa, you may want to stick around for this. Denitsa Sekova covers cross-asset for us, and I've got a great guest who wrote an incredible column. I love the title. Simon White says, when hedge funds are hedging, it's time to take note. When they're actually doing that.
Right, offering that diversification.
Exactly. Let's bring him in right now because, Simon, we talk about the difference between the dumb money and the smart money, dumb money being a pejorative term for retail investors, smart money, I guess investors hope, hedge funds and institutions. Are they going in different directions?
Yeah, I mean, we had last year, everyone was kind of universally long. So hedge funds were not doing, as you say, maybe what you'd expect them to do. And retail was long and everybody was long. And today you've had the Bank of America's Global Fund Manager Survey that's saying that investors are long in totality. But it looks like hedge funds are getting shorter. So Goldman Sachs had some data showing that the shorting of single stocks by hedge funds was 2-year high. But also if you look at the hedge fund research publish a number of hedge fund indices, and many more of them are now moving negatively within the market. So that suggests that funds are getting more short, but the retail is still piling in.
You know, it's interesting. I took a look through the 13F aggregate data and was pretty interesting to see that of the buying you saw in aggregate from all investors, you did not see the same type of excitement around certain sectors as you did from the hedge fund industry. And I'm wondering if this is because so many trades have already been so crowded, that the dry powder has been used and the leverage has been maxed out. How much of this is a need to become defensive?
Yeah, that's definitely true. I mean, when everybody's long, there's only one way to go. If you look at across the whole sectors, right, the household sector, the financial sector, the banking sector, they've never been longer relative to financial assets, US equities, and the rest of the world as well. So really, there's certainly crowding in US equities. There is all manner of risks that we're well aware of. I mean, even in the last few weeks, we've of course had DeepSeek, we've had tariffs, yet the market's still managing to scrape together, and it's near all-time highs. And that's not to say it couldn't do the same again. Really, it's the wall of worry, and once it climbs it, we could see more strength. But really, you've got so many headwinds. You've got excess liquidity is falling. You have, as I say, the overvaluation and the over-ownership of stocks, plus the fact you've got index correlation doesn't really get any lower. And that's a real source of potential risk, because if people have to start unwinding dispersion trades where they have to start buying volatility, correlations could suddenly rise very rapidly, and you're looking at a very different market. So it just seems that your risk reward here for owning equities has gone down, and maybe that's what hedge funds are thinking.
Simon, this is more of a comment than a question, so I apologize in advance. But to me, it always seems like positioning is kind of an ink blot test, because you can look at hedge funds, they're doing one thing. You can look at the Bank of America Fund Manager Survey. Apparently, people are the most risk on since 2010. And then you can take a look at money market funds, which still have $7 trillion in them. And then you take a look at the ETF flows, and there's just money continuing being thrown at equities. So it feels like wherever you look, there's different stories there.
Yeah, that's absolutely true. I mean, you've got numbers of different metrics. ICI do metrics, ECRS, and sometimes they say different things. But from what the things I looked at in today's column that you referenced, I'm beginning to see a more clearer picture in that you really are seeing retail, they're not really pulling back at all. ICI's number for mutual funds and ETFs was a $200 billion annual rate, which is about as high as it's been in the last 10 years. And there is real data showing that hedge funds are starting to do the opposite. So I think that's the information content. You don't blindly follow the smart money, but when the smart money is going short, and retail is still piling in as today, that tends to coincide with market weakness.
All right, Simon, great having you on to talk about today's macro scope column. We're going to have you back to talk about gold, because I think that's also a fascinating story that you've been reporting on as well. Simon White there in London. Coming up, Cook Unity turns profitable. The CEO of the meal delivery service tells us what's in store after 90% growth in the past year. This is Bloomberg. The first chef-to-consumer meal marketplace is cooking up a winner. CookUnity, which began 10 years ago, is now turning a profit after seeing 90% year-on-year growth in 2024. The company sets up a Toronto service this May, which means it'll be expanding beyond these United States. Joining us here in the studio is Matteo Marietti, CookUnity CEO. Great to have you in the studio. Thanks so much for joining us.
Thank you for inviting me.
I got from a Spanish VC, one of my cousins, a CookUnity box a couple of weeks ago, and we were just shocked at the quality of the food, how long it lasted, you know, how much our kids ate of it, and I had never heard of it. So tell me about the business, how it's grown, and why it's only in the U.S. and I'm getting turned on by a guy out of Madrid.
Well, I mean, that last part maybe we leave it to just pure luck. But we started in the U.S. because this is a very big market that I think has a need for a new solution for food. I think people are very busy and not always prioritizing their food choices and their health. And we are doing something very traditional and something quite revolutionary. The traditional part is that chefs are cooking your meals, and that's why they taste like that. They feel so premium. But the revolutionary part is that we are investing in technology to enable them to do their craft.
I want to talk about the more boring part. Matt and I love to cook, we love to eat, we love to try new things from chefs, but what about cost? At the end of the day, how do you pitch to customers that this is something to do versus going to the grocery store and doing it yourself, particularly for that busy customer? We were talking about it in the commercial break. A lot of people are looking to services like yours because there isn't enough time in a day.
But how much is it?
Yeah, but how much is it? And does it save you money relative to the grocery store?
So the plans start at $9.99. And they go as high as $20 for ingredients like lobster, wild-caught salmon, duck, because chefs want to be creative and want to cook with all the ingredients that they love.
This is what, per person per day?
Per meal per person.
Yeah.
So meals are individually portioned. We're introducing a lot of new product lines, so larger sizes, kids meals, appetizers, protein onlys. But basically the cost is like cooking yourself. If you're buying from scratch, great ingredients, cooking, sometimes it's hard to keep up with waste recipes in a household. So the efficiencies come from a lot of economies of scale. CookUnity is doing over 50 million meals a year. A lot of chefs sharing the same kitchens. We have kitchens around the country where the chefs bring their teams to cook in batches because customers select their meals once or twice a week, and we can deliver several meals at a time versus ordering last minute delivery from a local QSR or restaurant that usually has a lot of fees and higher prices.
I mean, for what it's worth, too, $10, you're getting a salad in a New York City restaurant for more than $10.
Oh, absolutely. Yeah, it's just crazy, the prices that are being paid right now. And it's interesting to hear that stat that you're starting at about $10. But building on that price conversation, I mean, the price of eggs is ridiculous right now, and it seems to be only moving higher. You have other idiosyncratic things as well when it comes to cocoa, for example. And with that in mind, have you had to adjust prices, or what does that decision tree look like when you have all these different ingredients just being so volatile?
Yeah, so two things. The service started in 2018, so viewers can have a reference of our journey and what situations we had to face. The only price increase that we did was in 2021, 2022, when inflation was sticky and prolonged. Right now, we're not raising prices if one ingredient or there is volatility on a few things. Of course, if there was a more sustained inflationary process, we will have to do it eventually. But we're benefiting from growing very fast, so we can, on our turn, buy directly from farmers. And so far, that has worked really well for us, and we didn't increase prices in the last 2-3 years.
If you have this kind of growth, right, we said 90% year over year, if you're turning a profit, if you're looking towards international expansion, I would think an IPO is on the near-term horizon. Is that a good way for you to finance this kind of growth?
I think it is. We don't have a specific timeline, but we're definitely preparing for it, putting the company with the best practices. I think transparency is a great thing, both for our team internally. I also want all investors, retail and institutional investors, to know what we're doing to support our community of independent chefs. I want the chefs themselves to be able to own stock if they want to, but what's important to highlight is what we're doing is revolutionary for the chefs, because chefs on average in CookUnity are making more than $700,000 a year in their own income.
I saw a number of chefs have become millionaires, annual millionaires.
With the bestseller chefs making $4 million, $5 million a year. That is unprecedented for the culinary industry. So that's one of our motivations. And the second one is people stick and spend more year over year because this actually solves a real problem for them. So I think the public markets will receive it well. Right now, there is a lot of conversation about healthy eating. I'm proof that the product works. I have 3 kids, all young, 7, 4, and 2. I lost 25 pounds since I started this company. So I think that would be a good phase for the company.
Well, you look great, Matteo. And let's build on the IPO conversation, because an IPO would be one route. But I'm curious whether you thought about acquisitions, maybe being acquired yourself. You think about Blue Apron, for example, a competitor of yours in a broad sense, being acquired. Is that something that you've thought about?
No, we haven't put any thought into that. We are trying to build the world's best and biggest marketplace. We want to do for food what Spotify did for music. We want people to open an app and the best content of food, meaning chefs, recipes, cool. Dishes are available there. So we have a really long journey ahead of us. We're just getting started, so no, that's not an option.
So on your website right now, you're offering a promotion. It's get 50% off your first week, 10% off the next 3 weeks of dietitian-backed meals. Good promotion. Is this part of your journey to go public, to add a lot more subscribers, to give the public markets the biggest possible subscriber base?
Yeah, look, we have awareness below 10% nationwide. So I think that even if we're growing at 90% now, even if we sustain that for 2-3 more years, the penetration is still less than 1%. So in terms of the opportunity here, we were very early. So we see, as far as customers love it, as far as customers stay longer and spend more over time because we keep adding more recipes, more product lines. Adding new customers is important, but not our main priority. But of course, since we became profitable, we are spending more in awareness, in marketing, and it's working.
Matteo, great having you on the show. Hope you come back.
Thank you so much.
And join us again. Matteo Marietti there of Cook Unity. It's made me hungry, actually.
You're always hungry at 11.
It's
always.
Fair. That's fair. Coming up, top officials from the U.S. and Russia have wrapped up a 4-hour meeting in Saudi on ending the war in Ukraine. We'll bring you the latest on that. In the world of politics, this is Bloomberg.
The U.S. and Russia wrapped up over 4 hours of negotiations in Riyadh today. They agreed to more talks on resolving the war in Ukraine, but did not set a date for a meeting between the country's two presidents. And Ukraine's president, Zelensky, canceled plans to visit Saudi Arabia Wednesday. Joining us now in Washington, co-host of Balance of Power, Kayleigh Lyons. Beyond him canceling his trip to Riyadh, the fact that he was also left out of the conversations as they currently exist, how is this falling out among not only the relationship between the U.S., Ukraine, but their broader European counterparts as well?
Yeah, it's not just Zelensky that's on the outside looking in here, Shonali. It's those in other European capitals as well who had to convene their own summit in Paris yesterday for talks on the way forward here. That said, the talks in Riyadh that were just taking place between U.S. and Russian authorities did yield some progress. As you mentioned, they agreed to continue peace negotiations to bring an end to this war, according to the State Department, as soon as possible. And they will restaff their respective embassies in Washington and Moscow in order to continue that work in part. Another interesting outcome here is that the U.S. and Russia have committed to expanding their economic partnership ultimately when this war is over, which really just speaks to the different attitude this Trump administration is taking in relations toward Russia compared to the first administration, where it was Biden-era policy to not have any direct talks with Russia unless Ukraine was involved. And that really is the biggest storyline here, is that Ukraine was not at the table today. Volodymyr Zelensky didn't even know that these talks were scheduled to happen. He said it was a surprise to him and made it clear that Ukraine will not be agreeing to any deal that was negotiated without them included. Now, his cancellation of his trip to Saudi Arabia tomorrow is noteworthy. As we understood, he was seeking a readout of the talks that took place earlier today from the Saudis, so he may get that elsewhere. And I would note that Keith Kellogg, who also was not present in Riyadh for these negotiations, even though he is the special envoy for the Ukraine war, is going to be in Kyiv tomorrow. So perhaps we could look for more discussions that will happen then.
You know, I think back, Kayleigh, to Trump's first administration and his urging of our European partners to spend more money on defense. A lot of them, agreed that it maybe would have to happen, but few of them really raised the money and did it. Now it looks like, 8 years later, they realize it's high time to support NATO financially in a much stronger way. Is that one win that the White House is getting out of this?
Well, potentially, Matt, if it actually elicits behavioral changes from European allies, who Donald Trump has largely viewed, at least some of them, who haven't traditionally met that NATO threshold in terms of defense spending as a percentage of GDP, will do so more. Donald Trump has obviously floated that he thinks NATO countries should be paying 5% of GDP. Ultimately, that isn't a target that's necessarily realistic for all of the countries in the alliance. I did speak earlier this month with the Lithuanian foreign minister while he was here in Washington. Lithuania has committed to 5% GDP level by 2026. And when I asked him, is that realistic for everyone in the alliance, he said, no, everybody's going to be different. So clearly each country is going to have to take their defense spending approach differently depending on their financial situations, which is why there's a conversation now of whether or not it's going to take issuance broadly from Europe. If Eurobonds are actually going to have to be involved in this equation somehow, if there is going to be a ramping up of defense spending to compensate for the loss of what Europe has been relying on for decades, which is a strong U.S. presence in many of these countries in order to counter Russia. Clearly, this administration is not being shy about signaling that there is going to be a certain degree of pullback in terms of the U.S. presence.
All right, Kayleigh Lyons, all over the latest. Of course, you can catch her on Balance of Power. Our thanks to Kayleigh joining us from Washington. Let's go check on these markets right now. Not too much movement at the index level. The S&P 500 higher by about 0.1%. You can see the NASDAQ 100 flipping into negative territory right now. A lot of action if you look under the surface, though. We've been talking about Intel. We've been talking, of course, about Walgreens, both surging today. There's a lot of speculation about deals when it comes to both of these companies. We'll have to see how that develops, but you can see that traders, you guys, not waiting for details.
And, Meta falling more than 2.5% today after a significant winning streak.
The streak is over and then some.
Streak is over, and
it's the biggest weight on the S&P, right? Or at least one of the top two biggest weights on the S&P. I know Intel is one of the top two biggest lifts.
Yeah, Intel and NVIDIA. NVIDIA up about 0.8%, but that's good enough to be the biggest points contributor when you're that big, Matt.
Coming up tomorrow on Open Interest, David Leibovitz joins us of J.P. Morgan. Joanne Feeney joins us from Advisors Capital. And we get Diane Swong from KPMG. It's a show you don't want to miss. We'll see you then. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Tim Stenovec.
And I'm Jackie Davalos in San Francisco. This is Bloomberg Technology. Coming up, Intel shares are soaring on reports that both TSMC and Broadcom are mulling potential deals that would split the U.S. chip-making giant in two. Plus, Elon Musk's artificial intelligence startup xAI showcases its updated Grok 3 model in a fresh challenge to OpenAI. And we'll dive into concerns around AI safety as companies and governments appear to change their attitudes on how to make the technology safer. But first, let's look at markets. Tim, what are you looking at?
I'm looking at the NASDAQ 100, searching for a little bit of direction. You can see down, not even not even 0.1%, bouncing between gains and losses throughout the session. So far, traders watching the latest geopolitical developments, all eyes are what's happening in Eastern Europe. This is the U.S. and Russia agreed to more talks on resolving the war in Ukraine, but set no date for a summit meeting between Donald Trump and Vladimir Putin. Ukraine's Vladimir Zelensky canceling his visit to Saudi Arabia. So we'll bring you updates on that as we do get them. I am watching shares of Intel, though, up about 10% as we speak, surging after the Wall Street Journal reported that both TSMC and Broadcom are mulling separate potential deals that would split Intel into two. Now, the Journal is reporting that Broadcom would be interested in the chip design and market business. Well, TSMC is apparently interested in Intel's chip plants. Today's surge, though, does come after Intel had its best week all the way going back to the year 2000. Shares rose more than 20% last week on reports that the U.S. government is possibly getting involved with a plan that involves both Intel and TSMC. Jackie?
Let's get right to it with Bloomberg's Ryan Blastelica. Ryan, let's talk about those chip plants, which Intel is operating currently at a loss. What could a potential deal with TSMC mean for that business?
Hey, good afternoon. Thanks for having me. So yeah, still a lot remains unclear right now, but certainly this has been a real drag on Intel for quite an extended period of time. Obviously, the previous CEO invested heavily in the foundry business, billions of dollars, didn't really see too much of a return on that. It is well behind TSMC and Samsung. So people are really looking to see if there is any kind of, sort of rescue for the foundry business that is really expected to, really support Intel if there is some kind of deal coming to fruition.
Ryan, what would be left of Intel if TSMC and Broadcom were to succeed in this, as reported by the Journal?
Yeah, that's a great question. Again, so many details are still up in the air, not yet confirmed. I mean, there is such a focus on domestic manufacturing. Intel got a lot of money from the CHIPS Act. It was building out a factory in Ohio, for example. So there is certainly a geopolitical aspect to this. People want to see more domestic chip manufacturing. And if TSMC is able to work with Intel in some capacity, obviously that would probably be good for TSMC to have, more of a domestic presence here. Certainly good for Intel. But again, we really don't know what any of this is going to end up looking like if anything does come to fruition.
Ryan, let's talk about some other non-sexy names in tech, like IBM and Cisco. You wrote this morning that they're kind of seeing a run-up and showing themselves to be AI contenders. What's leading this enthusiasm?
Yeah, so Cisco last week gave a pretty positive revenue forecast, talking about the demand it is seeing related to all the AI infrastructure that is being built out. IBM earlier this year had a pretty strong forecast of its own, had some strong long-term sales targets. These are two companies that were sort of forgotten by a lot of investors. They are nowhere near, like you said, their sexy heydays, like Cisco, still below its dot-com era peak from 2000. But as it's starting to see a little bit more of a growth narrative, especially related to AI, people are taking another look. These are stocks that are, trading at pretty considerable discounts to the Mag 7 names. They have pretty strong dividend yields. So in a period of time when people are maybe wondering, have the Mag 7 gone too far? Is this story already priced in? Having some new AI stocks in there, especially mature companies with pretty solid cash flow and dividends and so forth, trading at lower multiples, you can see why people might be taking another look at them.
Well, let's stick with the Mag 7. Bloomberg's Ryan Vestelica joining us from Chicago. Always good to see you, Ryan. For more, I do want to bring in Dana Dioria. She's Group President over at Envestnet Solutions, also Co-Chief Investment Officer at Envestnet. Dana, we heard Ryan just now talking about the Mag 7. It's more than 30% of the makeup of the S&P 500, those 7 stocks. How are your clients diversifying away from the Mag 7? Are they overinvested in them?
Well, I mean, so beauty's in the eye of the beholder, right? So there's a lot of, research that suggests, look, if you are invested in the market's determination is this is what these stocks are worth, and they're invested where they should be. I think a lot of our clients, though, are looking at that, and obviously on Envestnet, we're talking about retail clients with advisors managing their assets, and they look to diversify in other places. They look to have an overall globally allocated portfolio that has international investments, that perhaps leans a little bit into small caps. But let's be honest, if you are, more than 50 cents on the dollar that goes into our platform goes into passive assets. So if you're there, you've got a ton of, you said it yourself, it's 30%, right, of the S&P. But even if you're in an actively managed strategy, it's very hard at this point to have a ton of tracking error to the passive index because it's performed so well in the last several years.
Dana, there's a couple of different ways that we can look at tech companies now. You have software, hardware, enterprise, and then the consumer focus. How are you thinking about how to bucket these sorts of investments going forward and the sorts of catalysts you're looking from each bucket?
Well, so I think, for the average client on the platform, it's more about the sector, and it's more about where is the sector from a market cap weighted perspective within the indexes? And then if you're in, say, a Russell 1000 growth actively managed strategy, how is that manager doing that bucketing? How are they thinking about playing the AI trade, for example? Is it a question of, do I diversify again away from, say, an NVIDIA, right? And this has been a big struggle for them because, you have to meet 40 Act rules around diversification in a lot of cases. And it's hard to do when you have more than 50% of, say, the Russell 1000 growth, invested in these Mag 7. And so I think that bucketing helps, where a good active manager who's able to look at the tech sector and say, okay, I see opportunity sets maybe in some of these suppliers to to the Mag 7, right? And these different parts of the market where I can still kind of take that growthy bet on AI and tech, but not necessarily, be so heavily focused on the Mag 7 and, not meeting those diversification rules. So I think that's something that, these managers struggle with. And every time we see sort of a dip, it's a question, is it a buying opportunity to kind of leg more into those types of things as opposed to actually diversifying? That's kind of the question.
Where can we find certainty? And I know that's asking a lot given these days, but when we think about where we can see the tangible return, you have concerns around infrastructure, capacity, and then at the same time in consumer, you just don't really know how these sorts of features are going to be monetized. Which one do you think holds more certainty for investors?
Well, I mean, I think the energy theme has been a huge one. It comes across, and so we sit at the junction of hundreds of asset managers, so we kind of get a good sense of where the zeitgeist is sort of leaning. And I would say to you that the secular trend in energy has definitely been a theme. I also think people understand that this administration is probably going to be not only pro-growth, but helpful in terms of energy centers, helping the energy sector in general here in the U.S. And I have a view, that we're going to have to meet the energy demands over the next several years and into the next, decade, et cetera. You're going to have energy sources from everywhere. It just is what it is. So sustainable, yes. More traditional incumbent, yes. We're just not there yet to kind of transition over to sustainable. So I think energy is a play that probably a lot of investors have focused on for this. And, particularly with this administration, they see the opportunity set there. Even before AI, right, our energy needs were going to increase. Just looking at demographic trends, population growth, parts of the world that are moving into a better standard of living, which is what we obviously want to see. But all of that is going to create energy demands even before you get to the AI trade.
Growth versus value. It's a debate that I've been having with guests since I started doing this. Is this finally the year? I mean, growth is one every year I've been doing this. Is this finally the year that we see value outperform?
It is so hard to be a value manager. Here's what I would say. January effect is interesting. It's not statistically significant, but there's a little signal in there. January did see outperformance of value. I think, look, the notion that we are higher for longer on interest rates, traditionally speaking, that should benefit value, right? Because more of those cash flows are coming earlier. And so when you have a higher discount rate, the growth stocks should theoretically be impacted worse by that because they have more longer dated cash flows, more years that you have to discount by a higher number. So yeah, theoretically there's some makings for that there, but we all know the AI trade can just, and or other secular trends can just blow that out of the water. So it's very hard, I think, in the short run to say what will win, what won't win. I will say, I think at the end of the day, valuation will always still matter. It matters more for medium-term expected return. To try to trade on it in the short run is, it doesn't have a good track record for that.
There's hope yet for value investors. Dana Doria from Envestnet, thanks for joining us. Now coming up, Elon Musk calls xAI's latest Grok 3 model the, quote, smartest AI on Earth. More on the new chatbot that aims to dethrone its rivals. This is Bloomberg. Elon Musk's xAI has debuted its latest Grok 3 model, promising advanced reasoning and even a new smart search feature. This comes just days after Musk made an unsolicited bid to buy Sam Altman's OpenAI, which was ultimately rejected. For more, Bloomberg Intelligence analyst Mandeep Singh joins us now. Mandeep, what do you make of this model? How does it stack up to xAI rivals?
Yeah, look, I think what they've showed is another reasoning model that can do well on certain benchmarks and clearly was trained on one of the biggest clusters out there when you think about, the number of GPUs they use for this model. So is there anything groundbreaking? I don't think so. But at the same time, what they're showing is all these LLMs are narrowing, the capability gap they had with OpenAI. And I still think OpenAI is the preferred model when it comes to the usage and the distribution they have created for themselves. It would be interesting to see how much upsell xAI can have on their own platform, Twitter, and whether users are willing to pay a subscription. That will be the real test, but clearly I think it scores well on all the benchmarks.
Mandeep, is the market big enough now and in the future for Claude, for ChatGPT, for whatever comes next that's being worked on right now? Is it smart enough for Gemini? Is it big enough for Gemini? Do we need all of these?
Yeah, look, I mean, we just got off the earnings season in the past 1 month, and it's very obvious that everyone is doubling down when it comes to their CapEx investments. So the market is big enough to answer your question. At the same time, our view is that the field is narrowing when it comes to the foundational model players. And that's where, only the ones with deep pockets, your hyperscalers or xAI for that matter, that can spend on these, billion-dollar training runs will be the ones who would have the foundational models, and they'll try to roll it out for all the applications to use.
Bloomberg Intelligence analyst Mandeep Singh joining us here in New York. Mandeep, thanks so much. Well, sticking with AI, meanwhile, OpenAI co-founder Ilya Sutskever is looking to raise more than $1 billion for his startup, Safe Superintelligence. It could value the company at over $30 billion. According to sources, San Francisco-based VC firm Green Oaks Capital Partners is leading the deal. For more, Bloomberg's Kate Clark joins us now here in New York. So where does this company sit in the AI world?
Well, this company is brand new. It was founded in June of last year, which makes its valuation even more incredible. The company is trying to create a safe superintelligence. So it's all in the name, but otherwise we don't know very much about this company. It is very secretive, it is very much under the radar, and it's just getting started.
Kate, what do we know about why investors are interested? As you mentioned, it's super new. It's not really generating much revenue. And you add on to the fact that kind of the word safety is almost coming out of vogue this year amid a new administration that doesn't really seem to put too much importance on responsible AI. What do you make of that? Like, what's kind of the hook here for a VC that's investing in this company?
There's one huge clear hook, and that's the founder, Ilya Sutskever, which, as you both know, is a co-founder of OpenAI, longtime chief scientist, and a chief architect of those AI models. People really, truly believe that he is a singular force and that whatever he builds will be a massive, massive success. The company has zero revenue, and we won't see a product for years, most likely, as it seeks to create this safe superintelligence. So truly, it is all about the founder in this one, and that is what's justifying this $30 billion valuation, which, by the way, makes this one of the most highly valued companies in the world. And I don't have the statistics in front of me, but I think having $0 in revenue and a valuation that high is pretty rare.
I feel like you're sort of emphasizing the fact that this company doesn't have a product at this point, and it's all on the founder, and it could be worth billions of dollars at this point. Can we say froth, or VCs saying froth?
VCs are saying froth. I mean, VCs are also saying this is a once-in-a-generation moment, and they want to get on board with people like Ilya because they do believe that someone like him can create the next trillion-dollar company. So if you believe that, then sure, it's a great moment. But I think outside of, maybe Ilya is a unique person who really will create that superintelligence, but you're seeing tens of billions of dollars go into one-year-old, two-year-old companies. It'll take 5 to 10 years before we know how much money venture capitalists will lose, but they will lose a lot of money.
That's Bloomberg's Kate Clark. Thanks for joining us. Coming up, we speak to Cato Network CEO Shlomo Kramer as the company sees a big revenue boost in 2024. This is Bloomberg.
Elon Musk's Doge team is said to be attempting to gain access to a broad range of taxpayer data, raising concern from Democratic lawmakers over privacy concerns. Strict U.S. laws prohibit the disclosure of taxpayer data, with some exceptions for law enforcement. According to sources, the team is seeking the data, but has not yet accessed it. Jackie?
Cybersecurity firm Cato Networks says they surpassed $250 million in annual recurring revenue for 2024. That's a jump of 46% compared to the year prior. Here with us is Cato Networks CEO Shlomo Kramer. Shlomo, at a time when companies are really on the hook to show that they can deliver, can you tell us where this demand is coming from?
The demand is coming from all sizes of organization that faces increased complexity of point solution and are looking for a platform to deliver their network security with operational efficiency and business agility. So it's all about digitally transforming IT security to serve the digital business.
Shlomo, are you seeing a decline in demand in terms of total spent on this sector due to investment in AI, or are you seeing investment grow here?
We are seeing consistent increase in spend on IT security. Actually, in the 4 years following COVID, spend of IT security out of IT budget has grown 40%, while we are not more secure now than we were 4 years ago. So actually, this is actually the increase in spend is the core problem that platforms such as Cato solve.
So how do we get more secure? If people are, and companies are spending more money, but they're not seeing the results when it comes to security, how do we get more secure?
We replace the 50-point products that an average CISO has with 3-4 core platforms. You know, a platform on the endpoint, a platform on the cloud, a Cato on the network side, all integrated together. It's much more manageable. It's much more agile. You can say yes to the business, and you can fit it within the budget and talent that you have.
Let's talk about venture capital investors. They're pretty excited about cybersecurity startups. They raised a bunch of money in 2024. You last raised a round in 2023, $238 million. I mean, is an IPO next for you this year?
As a growth company, we have many different options, both public and private. And the real goal here is to build a long-term leader in this new category called SASE, platform for network security.
Do you see that being as a possibility this year, though? I mean, if you were to perhaps speculate on who potential buyers could be, perhaps not just for your company, but kind of in the space in general as we see M&A tick up, what are you seeing?
We are really heads down on building Cato, and I won't speculate on any financing or M&A events this year.
What would be the next financial benchmark, though? You did say you've surpassed $250 million in ARR for 2024. What's the next benchmark?
So, you know, Gartner assesses the market as growing at 26% year over year to $28 billion in less than 4 years. And last year we grew much more than that, and we fully expect to grow this year also more than the market and take market share and continue to build the company.
What would you say is the market size?
It's a huge market. You know, essentially SASE, our category, is the third generation of network security. It replaces the second generation, which are the appliances. These are many tens of billions of dollars that are going to be re-architected. And 5 to 7 years from now, 80 to 90% of appliances are going to be replaced by a SASE cloud implementation. So there's a huge potential, and we are just in the beginning. Less than 15% of enterprises have started implemented SASE, and more than almost 50% of enterprises are saying that they are going to implement SASE in the next 3 years. So this is really the money time of this category.
Shlomo Kramer, CEO of Cato Networks, thanks so much for joining us. Do appreciate it. Well, coming up, we're going to take a look at how priorities around AI safety and ethics are changing with Hugging Face's chief ethics scientist. Taking a look right now of the NASDAQ 100, shares bouncing between gains and losses on the index, kind of doing a whole lot of nothing today. You're listening to and watching Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Tim Stenovec in New York.
And I'm Jackie Davalos in San Francisco.
Let's get a check on the markets. I do want to take a look at shares of Supermicro, which are just surging. Look at that, up 13%. It's extending gains for a fourth session in a row. This after the totally beat up chip maker issued an aggressive long-term revenue outlook and pledged to meet a NASDAQ deadline to file audited financial results. Supermicro has rallied almost 90% this month, putting it on track for the best month going back to May of 2023. And it looks like it finally could happen. Meta Platforms, the parent company of Facebook, Instagram, WhatsApp, and more, halting that 20-day winning streak. Shares adding more than 20% over that record run, though. Shares down about 2.3% in today's session. Well, creators of a new AI chatbot often claim their model is the best. The website Chatbot Arena puts those claims to the test, allowing users to test and rank these programs. And fans of the site likely knew that DeepSeek's R1 model would challenge US-built rivals. Bloomberg's Seth Figerman is here to tell us more about Chatbot Arena. What happens on this site?
Well, it seems fitting that the fate and the temperature of $1 billion industry is being largely shaped by a bunch of students at UC Berkeley. It's basically a blind test. You know, people can try out, I think, something like 200 different models on the site and pit 2 of them against each other. They don't know what they are, and they'll ask a question and see which one does better, and then they'll vote it up or down. And based on that crowdsourced ranking, we'll see which models are at the top of the leaderboard. So DeepSeek rose up pretty high for months leading up to the launch that captivated everyone. And today, as we speak, Grok 3 is riding high there too. So it's become a real bragging right for some in the industry.
But Seth, talk to us about some of the risks of some of these crowdsourced platforms that allow us to benchmark how well one model is versus another. What can go wrong?
Yeah, it's a great question. I mean, first off, it's not definitive. It seems definitive, but these are systems that could be rigged, and they're certainly not being tested for every different use case. I think the real point here is that, one, there are not that many, really agreed upon benchmarks right now for AI systems, and as these systems get better, there's even fewer. I think you're seeing hyperbolic named things like Humanity's Last Exam, for example, as a model to test it with. And I think also, at the end of the day, a lot of this is vibes. These systems are all kind of similarly competitive right now. So what might feel good for one person may feel different for another.
Always the vibes. Bloomberg's Seth Figerman, thanks for joining us. Concerns around AI safety appear to be shifting, and companies and governments are starting to change the language they use to talk about the topic. Dr. Margaret Mitchell is the chief ethics scientist for Hugging Face, an open source platform for building and training AI. Margaret, talk to us about this shift in tone that we're seeing, not just from lawmakers, but also from companies, as they're starting to really reckon with the fact that we're in a completely different era as it relates to AI safety.
Yeah, so in the US, we've seen a shift with US companies, so like Meta and Google, removing some of the language that they had in their various terms of use and sort of responsible practices. So it's less focused on things like accountability, less focused on not participating in surveillance, that sort of thing, and less of a focus on this general concept of safety. And there was recently this AI Action Summit where J.D. Vance came and spoke and said that he thinks that the focus should now be on opportunity. And it seems like the larger tech companies are following suit on that.
Margaret, if the large tech companies aren't necessarily the ones who put the framework into place when it comes to rules, regulations, does the government need to step in? What's your view there?
Yeah, so my view of the role of government, and people have different views here, is that the government should be set up to protect the people, not to protect companies, creating a marketplace of ideas that companies can sort of thrive in, but ultimately stepping in where companies can't step in order to make sure that there's a level playing field, that everyone can do the responsible thing within the context of market dynamics where you might accidentally destroy your company if you're trying to do all the things that are the best for the people, right? Like companies exist to make money. And so there needs to be a counterbalance that sort of thinks about, well, what if we're not making money? What if we care about people? And what can we put in place for all companies to abide by and then change the marketplace dynamics in light of that leveled playing field?
Well, David Sachs is crypto and AI czar. Are you confident that the Trump administration will put into place policies that will protect people?
I think the jury's still out on that. There definitely is interest in growing the economy. So they've spoken a lot about creating healthy competition, that sort of thing. I haven't seen as much of their thoughts on protecting people and what that is. I think right now there's sort of a reactionary force. So there's always pendulum swings in ethics. People care a lot about ethics and safety and things like that. And then people absolutely do not. I think we're having a little bit of a pendulum swing right now back to not being as concerned about foreseeable risks. But, hopefully the government will listen to the will of the people and step in where no one else will help them.
Margaret, just a couple years ago, we had companies and just a wide swath of the AI community coming out and highlighting the existential risks. Some of these AI safety groups kind of dubbed as doomer types, if you will. Elon Musk has a growing influence in Washington, and he's been one of those at the forefront of kind of highlighting these existential risks as he's building his own AI technology. What do you make of his influence, but also the existential risks that have been raised before?
Yeah, so there's a lot to unpack there. This is a really big discussion in ethics circles. There's a little bit of an issue where people who focus on existential risk tend to drown out the concerns about current discrimination. So that causes a little bit of tension in ethical discussions. Elon Musk in particular, I'm pretty concerned about the role he has throughout the government right now. But within the context of AI in particular, he doesn't seem to be someone who would really stand up for making sure technology is not discriminatory or doesn't disproportionately harm some subpopulations. So there's a pretty big risk there. Existential risk is now less of an issue. Within the past few months, we've seen some stepping down from that as part of these pendulum swings. And so one would hope that that would mean that the immediate and current harms of AI would have more of a center stage. But as it seems to be right now, neither current harms nor foreseeable harms are really much of the focus.
Even coming out of the Paris AI Action Summit, so much of the language shifted from safety to security, the UK Safety Institute being rebranded as the UK Security Institute. Who should we look to as a leader for, how to build not just innovative technology, but also responsible AI technology?
Yeah, so there's a bunch of different ways to kind of approach this. One is via governments and one is via different companies. So the company I work for, Hugging Face, takes a approach of being transparent and open, because that's a way of making yourself accountable to people. So even in marketplace dynamics where you're sort of going for profit, you also have to show your work and that you're doing responsible things. So this is an area where openness can really be helpful in helping drive forward responsible practices. And then, there's also been a lot of really nice work in the EU on legislation. The EU and the US are not currently fully aligned on what to prioritize. But I've definitely appreciated a lot of their work on legislation that looks at foreseeable harms and risks as well as benefits.
Margaret, what are the stakes here? Like, what could go wrong if we don't get this right as a society?
Yeah, so we're in a situation right now where there's a large centralization of power for the AI companies and the larger ones, and they're accruing a lot of wealth while a lot of other people are losing their jobs. And so there's more and more of a divide between the have-nots and the have-yachts, as Trudeau said recently. So you're really seeing that the wealthy people are getting wealthier, and people who are just struggling by are losing their jobs or having their data used in these AI systems that then the larger tech companies are benefiting from while they can't even get, a basic income. So this massive divide is happening right now. There has been some discussion about UBI, like universal basic income, but I haven't seen that really moving forward in the AI world, despite the great idea there. And so that's happening now. And then that also means that people who are disempowered are going to be more subject to things like surveillance, more subject to non-consensual usage of their content in a way that it can be used to further harm them, not give them the medical benefits they need, this sort of thing, because of something they had said on social media. You can get into really nasty territory in terms of the rights to the general public, the rights that people have.
Hugging Face's Chief Ethics Scientist, Margaret Mitchell. Thanks so much for joining us, Margaret. Do appreciate it. Well, now Carson Block, founder and CEO of short seller Muddy Waters, sat down with Bloomberg's Haslinda Amin to discuss Elon Musk's empire and Tesla's future in particular. Check it out.
It's one thing to ask whether you bet on Elon Musk, but I would not bet against him. So I don't count the capital structure arbitrage trade as betting against him because it was pretty hedged. Maybe that's me being intellectually disingenuous, but I wouldn't bet against him. Now, in terms of the robo-taxis, literally, I think he's been saying that Tesla's robo-taxi capability is imminent. I think he's been saying that since 2016. So, take that with a grain of salt. And you do see in the U.S., Waymo is offering robotaxi services where I live in Austin. It won't drive on the freeways. My understanding is that Tesla's technology, because they won't use LiDAR, is not up to par with Waymo or even with Cruise. So, yeah, I'd be skeptical of that. I mean, do they find a pliable local or state government somewhere in the U.S. that says, okay, you can run this service here? Yeah, maybe, but I don't think it's, even Waymo is not ready for prime time if you're not driving on the freeway.
So, Carsten, would you be a buyer of Tesla then, or not?
Well, I'll check with the quantitative screen that we have and let you know.
But as it stands now, I mean, given where he is with Trump, given his relationship with Trump, given the chances of him being able to influence regulation, for instance, how does it play into your calculation?
Well, that's really a double-edged sword. I mean, one of the things that I was just, marveling over on the, 16-and-a-half-hour flight here was when you look at how Elon Musk has really changed his positioning politically over the years. He used to be a darling of the left, right? Pounding the table that, we need to electrify the economy, we need electric cars, or else we're going to die as a civilization, we're killing ourselves with CO2 emissions, et cetera. I mean, politically, we know that he's totally switched poles. But, he's allied himself very closely with the no, let's be realistic here about energy transition. If we're going to transition, we need natural gas, we need nuclear, and, electrification is a pipe dream. We don't have the battery technology. That's what the smarter people on the right, and I happen to agree with those views, that's what they're saying. So Elon Musk is now aligned with them. So my question is, with all the focus that he's putting, all the energy he's putting into Doge, which, by the way, ahead of the election, I had no idea whether this was really just him trying to be a provocateur or whether he was serious. He's serious. He's really